Charles Diebel, responsable de Renta Fija de MIFL. Charles, good morning.
Good morning.
How much is the market pricing with respect to monetary tightening? What will the Fed do today, tomorrow in this meeting?
It's obviously been dominating the market psyche for quite some time. The market is discounting a 50 basis point rate hike, which is more elevated than was anticipated a number of months ago. But the Fed members have been signaling a fairly hawkish stance. So we probably have a series of 50 basis point rate hikes as they at least move towards neutral. I think potentially more importantly, we'll also see the start of quantitative tightening, which means they start effectively removing some of the QE that they had put in to support the system in years gone by. And that removes a lot of liquidity from the system. And that's why you're starting to see some attention being paid, particularly from risk assets. So credit markets or even equities are starting to respond to the prospect of this liquidity removal from the market. So tomorrow, I think we see both. We see a 50 basis point rate hike and we see the start of QT, as it's called. But I think also a lot is going to be dependent on the messaging and how far it seems they feel they have to go, because it's worth keeping in mind some data releases are starting to soften up on the growth side. So at the moment we have the prospect of inflation remaining resiliently high, but growth starting to fade as central banks tighten policy. And that's not a good mix for pretty much any asset class. A lot of it will depend on how far the Fed think they have to go to actually start to control inflation.
We're seeing the sharpest bond market sell-off in 50 years. Is it time to buy?
I think we're getting there. Actually, yes, is the answer. Although the sell-off has been very dramatic, the scale of this sell-off is equivalent to the last major tightening cycle we had in the middle of the last decade. But the real difference is the speed. That took approximately 3 years from trough to peak in terms of yields. This has taken about 4 months. So there really has been a radical tightening of financial conditions, and the market has moved a lot with this reversal from the central banks. And I think that certainly with US 10-year yields getting towards, 3% this morning, and German yields at close to 1%, that's getting attractive, particularly in the longer end of the market. The front end still going to be under pressure because the central banks are raising rates, but the long end should perform better and start to attract some interest at these kind of yield levels.
We have seen euro against dollar 1.05 this morning. Will it weaken further?
It's already relatively cheap. It's certainly below fair value, but partly the reason has been that you've seen this significant hawkish tilt from the Federal Reserve in the US, and although the European Central Bank has turned somewhat hawkish, it's by no means looking to be as aggressive. So the prospective rate differential has argued in favor of the dollar. Plus you have the background geopolitics, which generally is a dollar positive. When the world is an uncertain place, people tend to buy dollars. So I think the euro is probably going to base out between here and around 102. So between 102 and 105, I think the euro should start to base out, and then in the longer term should move back towards fair value around the 115 level over the next 2 years.
Geopolitics remains in the center of these concerns about global economy. Is it still a factor for markets?
Well, I think the way it's going to be a factor for markets is going to change. Obviously, there was a huge shock and a huge reaction to events, for example, in Russia and Ukraine a couple of months ago when it first occurred. And to a degree, the markets have calmed down a little bit about it as the sort of new news element fades. But I think potentially the more worrying prospect is that this becomes a very long and drawn out process. And thereby it means that a lot of the distortions that it's causing, both to the global economy and to the humanitarian crisis and all of those aspects, is going to go on for a long period of time, and thereby it becomes more impactful to the global economy and more impactful to human lives. And I think that's where the worrying aspect is. So I think it does matter and could, going forward, actually matter more in that people have to factor it in to their expectations from an economics point of view, rather than necessarily thinking that it will be over in the near term, although obviously we hope it would.
Thank you very much, Charles Diebel, responsable de Renta Fija de Mediolanum International. Good day, good business, Charles.
Thank you very much.
Thank you very much.